Today we're going to talk about self-directed IRAs involving real estate. When does UBTI and prohibited transactions create criminal tax exposure? To begin with, the self-directed IRA holding real estate is not automatically illegal. In fact, real estate can be a legitimate IRA investment. The danger begins when the IRA account owner starts treating the IRA-owned property like personally owned property, paying expenses personally, using the property, managing it like a side business, ignoring debt-financed income, or relying on an advisor who says the structure is tax-free, without analyzing prohibited transactions or Form 1099-T exposure. What looks like a retirement strategy can quickly become a high-risk IRS audit or something much worse. Hi, I'm David W. Klasing. I'm a dual-licensed tax attorney and CPA, and for more than 25 years now, my team and I have been representing taxpayers facing complex IRS, California, and criminal tax matters, occasionally including self-directed IRAs, real estate investments, Form 1099-T issues, and prohibited transaction disputes. Today I'll explain why self-directed IRA real estate can become dangerous, especially where UBTI and prohibited transaction traps arise, and when a civil IRA mistake can turn into a criminal tax exposure. Real estate is okay in an IRA, but personal benefit is the trap here. The IRS does not generally prohibit an IRA from holding real estate solely as an investment, but the IRA must be treated as a separate tax-favored vehicle, not as your personal real estate company. That means the IRA owner, the beneficiaries, the fiduciaries, certain family members, and other disqualified persons must avoid transactions that create personal benefit, self-dealing, indirect benefit, extensions of credit, or the furnishing of goods and services. That is where many self-directed IRA owners get into trouble. They focus solely on the investment opportunity and ignore the prohibited transaction rules that go along with it. So what are the common prohibited transaction risks in having real estate inside an IRA? The prohibited transaction risk in real estate involving IRAs are broader than most investors realize. Common examples include selling personally owned property to the IRA, buying IRA-owned property for personal use, letting a spouse, parent, child, grandchild, or other disqualified person use or vacation at the property, using the IRA as security for a loan, personally guaranteeing debt connected with the IRA property, paying IRA property expenses from personal funds, taking compensation for managing the IRA property, or personally performing repairs, maintenance, or management services. That should be handled through the IRA by independent third parties. These are not technical footfalls. A prohibited transaction can collapse the IRA's tax favor status entirely. So what happens if a prohibited transaction occurs? Well, the consequences can be severe. If the IRA owner or beneficiary engages in a prohibited transaction, an IRA can cease to be an IRA. That can happen as of the first day of the taxable year in which the prohibited transaction occurred. That means that the entire account can be treated as distributed at its fair market value on that first day. If the owner is under age 59 and a half, the 10% early distribution tax may also apply, unless an exception exists. In a real estate IRA, this can mean that one bad transaction, one improper use, one personal payment, one self-dealing decision can trigger immediate income tax on the entire IRA account value. The second major trap is unrelated business taxable income, UBTI, including unrelated debt-financed income, often called UDFI. An IRA may be tax-exempt, but that does not mean all IRA income is tax-free. If the IRA earns income from an unrelated business, or if debt financing is involved, Form 1099-T may be required. This is where real estate investors often make dangerous assumptions. They assume that all rent, all appreciation, and all sales proceeds inside the IRA are automatically sheltered from income tax. That is not always true. If borrowed money helped acquire or improve the property, part of the rent or part of the sale gain may become taxable to the IRA and must be reported on Form 1099-T. And the fact that the loan is non-recourse does not make UDFI disappear. UBTI problems often appear in structures that the taxpayer thought were routine. For example, an IRA invests through an LLC or partnership that generates pass-through UBTI or debt-financed income. A short-term rental operation provides substantial services and begins looking more like an active business. The property is developed, flipped, or heavily managed. The IRA participates in an operating venture instead of holding passive rental property. Or the taxpayer relies on a custodian or promoter who says the account is self-directed and therefore tax-free. A custodian's willingness to hold the investment does not mean the reporting is correct, and a promoter's sales pitch is not a legal defense. Okay, not every self-directed IRA mistake is criminal here. Some taxpayers generally misunderstand UBTI, miss a Form 990-T filing, or accidentally mishandle expense without generating criminal intent. Those cases may require correction, tax interest and penalties, and careful civil advocacy. The risk becomes far more serious when the facts suggest that the taxpayer or an advisor knew that the transaction was prohibited, knew that income was taxable, and deliberately concealed the truth. Criminal tax exposure may arise where rental income was intentionally omitted, debt financing was hidden, personal use was concealed, IRA records were falsified, management fees were routed to the owner, or returns were signed knowing that they omitted UBTI. At that point, the issue is no longer just compliance, it becomes a willfulness problem. These cases also create risk for advisors, promoters, CPAs, attorneys, real estate sponsors, IRA facilitators, and other professionals. Anybody who knowingly helped a taxpayer hide UBTI, or disguise prohibited transactions, or file false documents. A professional who merely explains the rules is in a very different position from one who markets a structure as tax-free, tells the taxpayer not to file Form 990-T, prepares returns that intentionally omit UBTI, drafts sham leases, or helps hide personal use. But for the taxpayer, blaming the advisor is not enough. If the taxpayer knew that the facts were false, the defense must begin with a privileged, sensitive review of the documents, the financing, the property use, the expense payments, and the return history. If your self-directed IRA owns real estate, used debt, failed to file Form 990-T, paid or received funds outside of the IRA, involved personal use, or relied on an advisor who said the structure was automatically tax-free, whatever you do, don't try to unwind the investment or file late forms without legal advice. At the tax law offices of David W. Klasing, our dual licensed attorneys and CPAs help taxpayers, investors, business owners, and advisors evaluate prohibited transaction exposure. We look at UBTI and UDFI reporting, Form 990-T failures, advisor-caused problems, and, most importantly, potential criminal tax risk before a civil issue becomes something far worse. Call 1-800-681-1295 or visit Klasing-associates.com to schedule a confidential, reduced-rate initial consultation today. Because a self-directed IRA can be legal, but mishandled IRA real estate can create life-altering civil and criminal tax exposure. Dave Klasing, tax attorney, CPA.